Hello, welcome to the reflection deck for task B. So just a reminder, we are looking at the CICA December 2022 APC assessment. So task B was an integrated accounting and tax task. So a very interesting one, very practical, and even more so because it touched on a recent tax case between SARS and Click's stores. So we're going to touch on that as part of the reflection because I believe and strongly so that this was one of the consideration that you should have made before you set for the assessment. So what was then the context that we had to deal with? So you will remember that when we were covering document A, we encountered in the last slide the following paragraph, which then said Fodjan is considering introducing a loyalty program whereby customers are issued with a loyalty card free of charge and can earn loyalty points on their purchase. This sounds familiar. This sounds like a discount loyalty program. This sounds like a Clicks loyalty program. So we are not even taken aback by the fact that we are even we are seeing loyalty program like this. Even the likes of Spare have got this. So I think for me that is always a win because you are now dealing with something that is very common and quite practical. Then it goes on to say it is proposed that loyalty points could be redeemed as discount against future purchases. There will be no cash back. So that is the description of an opportunity that is available for FJ or Fodjan. And just to really then talk about what we have just learned or got from this paragraph, it is firstly that we see a customer, they get that card, and now they come to the restaurant, then they buy, swipe, and some points. Then sometime they will have points that say are worth, say, 100 rands. And what could then happen is that we will want to know whether they can convert that to cash. And this is saying, no, they cannot. That's one. Then two, and for those that have got Investec, I'm sure they will know, seeing that Investec is our sponsor, that if you earn the dividends reward points, what you can do with those dividends points, you can redeem them as reduction against your bank fees. You can redeem them as actual cash that is deposited in your bank account, if I'm not mistaken. You can redeem them by getting a card. So there are many redemption options. And it was quite great for the examiners to narrow it down, to say that these points that you then generate, you can only use them against future purchases. So that is what we are gathering. And at this point, there's no trigger. We know about it, happy, good, but there's no trigger. We should not be running and doing something about it, because if that's the case, this will be a very complicated trigger. It could have strategic benefits to say, what are the strategic consideration for launching this loyalty program? It could be an audit issue, that how do you audit this? It could be an accounting issue, how do you account for this? Or it could be a tax issue, what are the tax and VAT implications? But without a trigger, without an ask from the seniors, there is nothing that we can do. Thinking about it, perfect. Understanding it, perfect. But we should not go for an overkill because there's no trigger at this point. Okay. But then email B comes in. Document number 3, rather, sorry. Then they say, hi there. As mentioned to you earlier, our industry was hard hit by what? By the pandemic. We will need to think outside the box on how we can boost our revenues. You will have noticed from the PowerPoint presentation that we are considering introducing a customer loyalty program. Some of our competitors have implemented customer loyalty program quite successfully. In particular, one competitor issues family cards to customers, which entitle these customers to benefits such as discount vouchers once the customer spent a certain minimum amount of money at their restaurants, and access to exclusive promotions and automatic entry competition. Interesting. And I'm thinking that I've heard of a family card, Spare, I believe that's what they call theirs, where they're hinting that it's a nice one to look at. And given that it's FJ, and previously when we were talking about document A, we made some, we draw some similarities to the likes of famous brands, to the Spare Corporation. I'm thinking that this is some of those clear hints to say that it will be beneficial if I understand that for my purpose. Okay, so they've also mentioned that they are looking at customer loyalty as an opportunity to boost revenues. So I need to understand, how does a loyalty program boost revenues? Because earlier on, we had talked about DNA, data and analytics. Now the question is it linked to that, or is it a matter of then building loyalty so that the customers can come? And at this point, I'm now thinking from a strategic perspective. I'm not clear at this point what the trigger it's all going to be about. Then they say customer loyalty program on the subject, so it could still be anything. Then I go to the next slide. Although such a program obviously comes at a cost, and I'm now starting to think in my mind map, when you say cost, which costs are these? Do you need, obviously you will need a system, because we need to then say when the person swipes and then, or when they buy and they get billed, they swipe this card, then there should be some IT story happening in the background. What is it that is happening, and what does it take to have that in place? All these cards that are going to be given to the customers for free, they have to come from somewhere. The printing, and customers lose these cards and they will have to be reissued with some of them. The marketing of this scheme, I'm seeing it, and I'm saying that this, at this particular point, probably thinking that it could be a nice little NPV where I'm required to analyze the benefit or the revenue arising from the scheme versus the cost to be incurred. Then they say, although it might come at a cost, it holds many potential benefits. Then what are those benefits? My mind map starts drawing them out. For FJ and our franchises, such programs have proven to be effective in increasing customer loyalty in the restaurant industry. I mean, because they've now referred to SPA, to the family card. Hey, seems I got disconnected, but I'm back. Sure. So as I was saying, that one will then need to look to this proof that this statement is alleging, to say such programs have proven to be effective. What is the evidence of that? How do I know that these kind of programs are indeed effective in increasing customer loyalty? In the South African context or in your own country, is the evidence that indeed there could be that there could be an increase of loyalty and could then translate to revenue. The benefits therefore outweigh the cost. The more customers visit our franchises restaurants, the more revenue our franchises will earn. And the more revenue that they earn, the more franchise fee we will collect. It's a win-win situation indeed. Okay. So I'm quite excited about evaluating the financial benefits of this. I want to see that indeed the benefits outweigh the cost. And I want to be able to unpack just the benefit. Is it just muscles? In other words, what will it be that makes people come just because I'll give them discount? Because it might mean that I need to give them more discount than my competitor. It might mean that I need to give them this exclusive access, promotions, competition, and so on. So what will that essentially cost me? And indeed, is it really outweighing the benefits? Then they continue. The board is comfortable to consider the merits of such a program, but will draw on your technical expertise to give advice on the accounting and tax implication. So that was very interesting. The board is comfortable to consider the business merit of such a program. For me, that was a subtle negative trigger. So what is a negative trigger? A negative trigger is something that tells me not to worry about something. And safely so, it means that SAICA should not come and surprise me like, hey, surprise, we told you that the board is comfortable, now they're not. No. At this point, because the board is comfortable to consider the business merits, I'm thinking that all those questions that I had about the benefits outweighing the cost have been resolved because the board is comfortable in doing that. They don't need my assistance. They've not triggered my assistance, but rather they've triggered that they will not be needing it. So I shall not, therefore, be investing time in exploring the benefits against the cost. But they were clear what they wanted from me. But will draw on your technical expertise to give advice on the accounting and tax implications. I was like, oh, will they now? Because I'm going to learn myself. So it will be quite interesting that the board will be drawing on my technical expertise. And I'm thinking that my technical expertise, I've got silk right in front of me here. It's not appearing so nicely, but yeah, yes. I've got silk and I've got what? And I've got my accounting standards. So this is the expertise that I need to have and therefore demonstrate them to what? To the board. But imagine, I've got less than 5 days to do so. We will chat once I have more details. So Elijah has left me in the dark once again. The thing that is given me or she's given me, it's such a very broad trigger. But what can we do? Let's unpack the trigger. P.S. While we are talking about revenue, I didn't know we were talking about revenue. Oh, yeah, no, sorry. I must point out that there are no uncertainties on how to account for our existing revenue streams. Elijah, you are a star, another negative trigger right there. So Elijah is telling me that when I'm thinking about customer loyalty, which is an IFRS 15 matter, I should not be worried whether there will be uncertainties about, say, whether the sale of the goods, the payments obligation, whether this and that and this are accounted for in this particular manner. He's saying or she's saying we are all good there. So my focus is now been directed to accounting. But because, let's then read further. When the new IFRS 15 became effective about 5 years ago, we consulted an IFRS expert who assisted us with our revenue recognition. Why are you not consulting him again? When it comes to what? When it comes to this customer loyalty, I wonder. Our auditors, Greener and Co., expressed their complete satisfaction on how we account for revenues, and there have not been any significant changes since then. Clear negative trigger. I hope no one then gets to the IOD and say, oh my God, I'm shocked with what I'm seeing, because that will be very unfortunate because they were clear about the negative triggers, but whether they were clear about the positive triggers is quite debatable. So now it brings me to a very interesting point to say that when I'm faced with a question that simply, or rather a task or a trigger that simply says accounting implication, what is it, therefore, that I need to be mindful of? What is it? And for me, this will be the standard framework that if you tell me you need help with accounting, I'm going to think about that as accounting treatment. So whenever the trigger just says accounting, I am reading accounting treatment. So what is accounting treatment then? One, it is how does this thing get in the books? Recognition. Two, how do we measure it when it gets into the books? How do we present it in our financial statements? And lastly, how do we disclose it in the notes to our financial statements? So I need comfort over everything. That's how broad the trigger is. So they could actually say that, yeah, as we are now putting this together, I've prepared some illustrative disclosure. I cannot say I didn't see it coming because they just said accounting, and I'm saying that accounting will capture those four things. Whenever you encounter an accounting issue and they are not clear about what is it that they want, like when we look back on the task A, they said accounting for the acquisition of the 100%. So they had given us guidance. I would have been very surprised if then goodwill is recognized and it's been impaired. Like, where is that coming from? But here they said accounting treatment for customer loyalty. Therefore, what I needed to do was to first determine which standard deals with customer loyalty. Is it IFRS 15 or is it IAS 37? Do I have an obligation? Do I have an obligation when I enter into a contract or a loyalty program such as these to give people discounts in the future? Or is it deferred revenue? Interesting. Then that query will be easily and quickly resolved because IFRS 15 is quite clear that customer loyalty falls under it. But what is always quite important is, now that I understand that accounting deals with those four things, recognition, measurement, presentation, and disclosure, I need to then say, what is then the anticipated task? The anticipated task could be that we need to prepare a memo dealing with those things. 4. Or otherwise, it could be that they've prepared some journals that I need to review, or they could ask me to prepare the journals, in which case they'll be dealing with just recognition and measurement. Or instead of preparing a memo, they could then say, here's the memo that I've prepared for the board, and I'll require your technical expertise to review it. So this is my starting point in terms of what? In terms of the anticipated task. You can go a step further and say, maybe they will just show the impact on P&L and SFP, statement of change in equity, and say, review the impact. Or have disclosure that they might present that they want me to review. So that could be another potential trigger as well. Okay, so what do I need to revise? Now that I've come to understand that this is an item that is dealt with in IFRS 3, I've got a little bit more comfort around what? I've got a little bit more comfort around where to start. Then I page through and I find that, oh, there are these guidance that have been provided in the CTA videos, in the standard, that will then help me to unpack this even more. But when I look at it, I then said, how do I think about those 3 things or 4 things that I've mentioned in the context of customer loyalty? Because I need to always be in context. Number 1 is the recognition, right? is to say, when will I recognize this differently? Is there a case that I might not recognize this customer loyalty at all, that people will be getting points, and I said there is no effect that will just need to be dealt outside the books? No need to worry about recognizing it. Or did they need to be recognized? And if so, how so? Then number two is that once I've recognized them, at what amount do I put them in my books? So the principles of allocating the transaction price to the performance obligation. Then thirdly is to understand that there might be a mismatch, recognition now again, between the time I receive the money when people are buying to the time that I recognize the revenue. Because that's the thing with customer loyalty. As we will soon find out, is that when you are buying and swiping your card, the moment you swipe your card, it's like the retailer then takes a portion of your money you're paying today and allocates that to the point that you, by swiping, you've essentially bought two things. You've bought the goods and you've bought also the points. Then the other thing is the disclosure related to this customer loyalty and the impact on revenue. Because as we'll get to see later, they do take a portion of revenue and defer it. So now that creates uncertainty that you will want your users of the financial statements to be aware of and understand better. So the standard does give us guidance on how to disclose that for the benefit of what? For the benefit of our users of the financial statements. Okay, so that is the accounting. Then they also mentioned that they will need to draw on my insights or my expertise on what? On tax implication. And again, because tax is silent, then I need to consider both the income tax implications as well as the value-added tax implications. So essentially here, it becomes a very interesting point. And we need to therefore recognize that there are two transactions. And we'll soon unpack whether this is the same transaction, just extended over a long period of time, or these are indeed two separate transactions. Remember, with a loyalty or scheme, which is something that I discuss also a little bit more in the guidance, in the CTA videos, is that you, as I was saying, you've bought the goods, and before you walk away, that bread is worth 20 Rand and you are ready to take it. Then they ask you, do you have a Clicks card? Do you have a Discount card? Do you have whatever it is? Then I say yes. Then they're like, tell you want to tap or swipe it. Then I said, let me swipe. Then they say you've earned 10 points. So in that transaction, the transaction changes. I've now bought 10 points and I've bought what? I've bought the bread. So that is what is happening. And the points, I'm going to use them when I come and buy bread in future. When I'll ask, I've got 10 points, what are they equal to? Then they will say that each point is equals to a Rand. Oh, no, that's brilliant. That means I've got what? I've got 10 Rand because I've got 10 points. So essentially, I can now apply the 10 Rand against the goods that I'm buying in the future. So now, when we understand that, because for tax, it's always about the transaction. Understand the transaction before you get to the law. What is happening? So now, now that we've unpacked that, let's now look at the income tax implication. So firstly, there is a sale of goods. And because I've swiped, as well as the sale of the points to me. And the income tax is clear. When do we recognize and when do we get tax on the proceeds as what? As FG or the franchises. So they are taxed on the earlier of receipt or invoice. So now the fact that one has bought the points that are going to be used later on, then from a gross income perspective, all that money you are entitled to, because there was no issue about the customer now exchanging the points for what? For cash. So that is the principle of what? The area of accrual and receipt. Okay? Then number two, this is quite interesting because now the customer has bought the points as well as the goods. So the goods, I can see them walking them away with them. So that is clear that the cost of the goods is easily matched to the revenue. But what about the points? Because now what is happening is that the customer is now accumulating all these points. And when they're giving money when they are giving money for buying these points that they are planning to probably redeem, say during Christmas period, then I'm getting taxed. I'm getting taxed. And the question is, I might expect that this person will be buying silk for 2020 what? For 2024. So now I'm saying that, I can see that the cost of silk will be deductible in the future. So I've got the expenditure in the future, but I've got the income now. And as you were just dealing with Fedi in a recent session, it goes without saying that 24C kicks in. 24C then kicks in. Remember 24C kicking in, what will it mean? It will mean that I've got some relief because I'm only going to incur the expenditure in the future. But 24C does not just apply, as we'll get to see. It has got some criteria that we'll need to look into. And this were made much clearer in the recent case between Clicks Retailers versus the Commissioner of SARS. Okay. Then what about the expenditure? The one that we're saying that the cost involved in this program. So the system that I was talking about, the marketing that I was talking about, what about all those things? The one that I incur now, not later, can I deduct them? So certainly so, because they're in the production of generating an income. As we saw, it's a win-win situation. You generate revenue, I generate revenue, everybody generates revenue. So that means that one could then be able to claim the expenditure incurred against what? Against that gross income. So the task, so that I don't lose myself, what will be the task? The task that I'm anticipating is I will either be required to discuss or review the tax implications relating to this loyalty points. But I said that when I've got tax implication, I need to be mindful of both income as well as value-added tax implications. So now let's talk about the VAT. So first and foremost, the question is always a matter of, are you undertaking an enterprise when you are running this loyalty program? Are you entering into enterprise? Are you furthering your enterprise? And the answer is yes. A loyalty program is part of furtherance of the enterprise of the entity. So it ticks the first It ticks the first requirement. Then secondly, we need to then ask ourselves, when do we account? Because remember, we are selling these points. When do we account for output? When do we account for the output tax? Because we are selling the points. When we are selling the goods, it is clear. Excuse me. The goods is clear that bread example, the bread has been sold and the output will be levied. So that I'm clear about, done. But what about the points though? Do I get levied output tax there as well? Or should I levy output tax when I'm entering into transactions related to the loyalty scheme? So the guidance then is sitting in section 10, 18, 19, and 20 of the value-added tax. So let's just quickly talk about them. So when we talk about 18 deals with gift vouchers. So sometimes, farewell, baby showers, you go to Woolies there and you then say, I want to buy a 500 too little for a baby shower. Okay, I want to buy a 1,005 gift voucher. So I've got it. So now the question is, when Woolies sold it to you, did they charge VAT? Because they've said that this is not refundable or exchangeable for cash. So you've given them 500, they've given you a card that is 1,005, and you now have a card loaded with 1,005. At what point will they levy VAT? What do I mean at what point? Because now when I give to that friend of mine who's having a farewell function, a celebratory moment, and so on, they will then go take that gift card and go to Woolies, pick up the goods that are vettable. And they will then want to do what? They'll then want to swipe the card. So at what point, because we also don't want to be charged VAT twice, do we charge VAT when we sell the what? When we sell the voucher? Or do we get to pay out and levy output VAT when we sell the goods? So the Tax Act, or the Value Added Tax Act, then clarifies that in that instance, when the voucher or the gift card is bought, there are no VAT implications. It's like you've just changed the form of money. 500 was in your card, now it's sitting in a different card. That's essentially the transaction. So no value has been added. Then when you buy now the goods with that, then that's when the likes of Woolies will then account for the goods. So in other words, the gift card or the voucher that has been bought, it just serves as a form of consideration. That is what we learn from 1018 of the VAT Act. What about 19? What does 19 then say? 19 now deals with a situation where now, what do we have? 19 is a very interesting one. It then deals with a situation where now the voucher that I bought you, it is for something specific. It's just like when I bought you a voucher that can be redeemable for a movie ticket, right? So in this particular instance, this thing is now linked to a good. So that could be that, oh, we know Westlife was just around the corner, or was it? It was just in South Africa. So it could be that I bought you a voucher that will then be redeemable against the Westlife ticket, which you can go or you may not go. Or in this case, you might have gone or might not have gone. So the issue that we are dealing with here now is different from the 1,500 gift voucher, because that can be what? That can be a situation where we now have what? Where we now have differences in the voucher value as well as what is being bought. But here, this is linked. It's like I paid for this in advance. So the transaction has already been entered into. So when I go and convert it to a ticket, it's not like there's any further value added there. By having this right now, I already have what? I already have the right to a ticket to see Westlife. So do you see that? So that's 1019. So 1019 says that when I buy then a voucher that is linked to a particular good, then the VAT is levied at the point of buying that voucher. Then 20 talks about a situation like e-bucks. When we've got e-bucks, then you earn the points with F&B, but you can use them on Take a Lot, the same with Discovery. So the points are earned at different points and they can be used with a different suppliers, kind of. So what we are now recognizing is that there is the issue of the voucher, as well as the what? As well as the point at which the vouchers will be redeemed. But is that the case that is applicable to FJ? And no, not so. Because in the case of FJ, we've got FJ being the issuer of the voucher, as well as the what? As well as the redeemer of the voucher. So in that instance, 20, section 10, subsection 20 of the VAT Act is not applicable. So you can then exploit further from Silk, and that's the reference paragraph right there. And in terms of the task, I might be given a memo where I need to unpack this for the board because they require my technical expertise. Or otherwise, I might be required to do it. Otherwise, I might be required to review a memo that has been prepared. So that is the accounting, income, and tax. So it was a packed case study, this one. Now that I'm realizing, because if you think about it, the task that you will have gone through with Fedi had audit and tax, and now this one is accounting and tax. So this was a very packed case study and very practical, though, very interesting. And I hope you did enjoy it while you are working through it as much as I'm doing. Then let's unpack the accounting issue. So the first one we asked, will this result in a what? Will this give rise to a separate performance obligation? So the standard says that it will if it's a material right. What is a material right? I wonder. Then they say a material right is a right to which the customer will not have been entitled to had they not entered into a contract with you. What does that mean? It means that I could never wake up and then just get Clicks points. I will have to go to Clicks and enter into a transaction with them. Okay? Oh, am I right? I don't have a Clicks card. Maybe you'll know better. But let me just make that example. Because I think now when I'm saying it, I remember that I think there was an instance where they sent someone and they said it's your birthday month, so you're going to get a 50 Rand voucher. So that will not be a material right because the customer got it without having entered into a contract with Clicks. They were just celebrating their birthday and they got that. So that will not be a material right. But the points that they get by going and entering into a sales contract, that is a material right. Then the standard goes further. They say, if the option provides a material right to the customer in fact pays the entity in advance for future goods or services, and the entity recognizes those revenue when the future goods and services are transferred and or when the option expires. So it's like when the points expire, like the Pick and Pay ones. Mine expiring soon. I need to buy, I think I can buy sweets at most. But anyways, so that is essentially how this works. So what is the test? Is it a material right? When do you have a material right? You have a material right if you will not have gotten this right unless you entered into a contract. Then what happens? When you have the material right, you are in fact paying for goods in advance and therefore revenue deferred and only recognized when those goods are transferred to you. Tick. Then I reflected on what Elijah, our dear friend, or dear CFO, told us. He or she mentioned some of our competitors have implemented these customer loyalty programs quite successfully. In particular, one competitor issues family cards to customers, which entitle the customer to benefits such as discount vouchers once customers have spent a certain amount of money at their restaurants. So this is likely to give rise to a material right because this benefit or discount vouchers, a customer will not be entitled to them by virtue of just having the card. they need to spend and reach a certain threshold. So that is what we mean when we say they will not have gotten it without a material right. And then they also get access to exclusive promotions and automatic entry into competition. So that is likely not going to be a material right. So now we are understanding the recognition. Then, next, it's what it is, the principle of allocating the transaction price to performance obligation. So the measurement. Now that I'm recognizing that there is a material right and it is an entitlement to future goods and services that I'm effectively paying in advance, how do I then do that? So that means there is indeed value or a standalone selling price to those points and to the goods that I'm buying. So when I am giving the likes of Clicks, the likes of Discam, my money, I need to be able to split it between the points as well as what? As well as the goods that I'm buying. And the principle of allocating, it's well covered in what? In the standard under step number 4. But more so, it is also covered in the example that I deal with in the CTA video. So after doing this, I'll want you to then work through the CTA video because it's got more detail and even has calculation and journal entries to help you to better unpack what we are talking about. Then they mentioned that obviously, because the points, I've never heard anyone say, I then decided to just go to Discam and bought myself these points. Investec does sell their points, surprisingly, but I've never heard anyone say, I bought Discam, I bought Pick and Pay, Smart Shopper points. I've never heard that. So the points, therefore, their standalone selling price are not directly observable, and we might be required to estimate them. So how do we estimate them? We take into account any discount that the customer could receive without exercising that option, and the likelihood that that option will be exercised. So I'm gonna keep it there so that when you go through the example, you can clearly see how to then do this. Because right now it's a little bit washy-washy or fuzzy here and there. Then lastly, it is the principles for accounting, because we are receiving the cash now and the revenue later. So how do we do this? So we are saying that to the extent that the goods are delivered or transferred to the customer, when I take the bread, then revenue has to be recognized. But to the extent that I'm paying for the future goods, and that is kept record of through the points, then I recognize a contract liability. So the example, once more, very detailed and give appropriate guidance. Then a lot of the things that we've got, so in the context of food FJ, the general principle that I've mentioned are equally applicable here, because the customers, we are told that what, in the initial thinking, we are told that they will earn and they could earn points on their purchases, meaning that they will have to enter into a contract which will then give rise to a material right. So that is now in the context of FJ. Then we are saying that clearly the food, we know their prices. There is a menu that we can go to right now. So the goods or the standalone selling price of the goods, that's fine. So we will need to estimate the value of the loyalty points. But we saw that it considers the likelihood of the number of points that will be redeemed. But this is the first time we'll be doing that point. So there is a significant uncertainty around what? Around these points. So that is something that we'll then be mindful of, that we might not be able to get it right. And we might need to use a bit of more adverse kind of weight. We might end up with some kind of adverse, or unless there is sufficient data to motivate our, say, percentage of redemption. So that's something that is not cleared up that we'll need to be mindful of. Then the VAT implications, I have then mentioned that in what? In unpacking what happens to the output for the goods as well as to the points, and also and also what? And also the input relating to the cost related to what? To the cost that the operator of the loyalty program will then incur. Then we've got these income tax implications and the clicks versus commission of SARS. What case? So this is a very, very interesting one. And let's just unpack 24C quite carefully here, because I did mention that it's got criteria. So these are the criteria that are there in 24C. So let's start with criteria number 1. And this will help us to understand what happened in the click case. So firstly, it says that the income accrues to the taxpayer in terms of a contract. That one ticked, because we are going to have customers buying food and therefore entering into a contract. So that's clear. Number 2, there is an obligation on the taxpayer to incur future expenditure, which in part or in whole will be financed by what? By this income. Tick. We will need to then give future what? Discounts or free food. All right. Number 3, the income and the obligation to incur future expenses should flow from the same contract. Now, this is where things broke down. What do we mean they should flow from the same contract? And in the case of some of the loyalty programs I've been making an example with, is there 2 contracts or is it the same contract? Because we need the same contract for 24C to apply. So essentially, in the case of clicks, it was found that there was the sales contract and there was the loyalty or the club card contract. And those needed to be tested for sameness. And when they were tested, they found that no, these are separate contracts and they should not be considered to be the same one. So that criteria was not met. And there was an additional consideration, though, that needed to be made to say that if now there are different contracts, when the contract which then gives rise to the income and the contract that gives rise to the expense, are they inextricably linked? In other words, it's like they're interwoven. You cannot separate. The two are interconnected, in other words. Remind me of IFRS 15, paragraph 29. They're highly dependent, highly significant. So they are intertwined. They are inextricably linked to each other, such that they've got this criteria of sameness. So if that is ticked, then you can end up with the third requirement of Section 24C being ticked. So at this point, it then became necessary for one to really unpack the same contract principle as well as the sameness basis, whether that will then be linked and applicable to the case of what? To the case of FG. So that case needed to be studied ahead of what? Ahead of the IOD, in order to ensure that whether all the 3 criteria are met or not met. So those are some of the things that one needed to be mindful of. So I've provided more guidance here, which you can then have a look into. But when you deal with this task with Asen on Saturday, I'm sure he's going to unpack it even much more beautifully and see how all these things from accounting, income tax, value-added tax principles needed to be applied. So I'm sure you're going to enjoy, and all the very best with it. Thank you so much.